Welcome to Ben's Market Insights. This is the concluding episode of 3 episodes that we put together for our strategic asset allocation, our macro perspectives, and our micro themes that develop out of those macro perspectives. Today we are going to be talking about asset allocation. If you're enjoying this content, please give us a thumbs up and subscribe on our YouTube channel and also on our podcasts on Apple and Spotify. So let's jump in. Our asset allocation is significantly different to that of what I would call the generic global balanced portfolio. In this occasion, we're using the Morgan Stanley Private Investor Balanced Portfolio. And I'll tell you a little bit why that is. Largely, the issue is around country bias. We're from the UK, so there is a significant portfolio bias to the UK, and we'll talk about why we don't believe that that's going to help portfolios in 2026. So the key elements, let's talk about what that looks like from straight on asset allocation generic wise. So the PIMFA portfolio is effectively investing something like 45% of the total in international equities. You'll see 15% into UK equities, UK government bonds at 5%, UK corporate bonds at 15%, UK inflation linked at 2.5%, cash at 2.5%, real estate in the UK at 2.5%, and alternatives, which the way that PIMFA measures that is based on a portfolio of a long 100 global bonds, or a mixture of 100 global bonds, and short 70 of the MSCI, which is the Morgan Stanley Global Equity Index. So that gives the balance on the alternatives as a form of hedging. We disagree with that. We think, as I say, that domestic bias makes no sense. The UK accounts for less than 3% of global GDP and is likely to get still smaller going forward over the next 4 to 5 years. So our assumed allocation looks at the world in a very different way. So international equities, we're already thinking around 70%. And we'll break down that into specific countries. You'll see that based on what we've said previously about our macro and micro themes, the world is being led by the US, so we'll see a significant exposure to the US. We're also going to be looking at something no more than 2% for the UK, which is not only below the global GDP exposure, but clearly well below the balanced portfolio that a generic portfolio would have. And that's largely because we also believe from a macro perspective, the UK is not likely to have a good year. The Bank of England is likely to make some interest rate mistakes by reducing excessively or by reducing at all at a time when the fiscal deficits are going to expand and access to bond markets are going to be significant for the UK government. We don't look at specifically UK bonds, but rather at international government bonds at the mid of the curve. Remember last week we talked about that bear steepener. So we think on a risk-adjusted basis, when you're buying into government bonds, you should be looking at the middle of the curve, around 5 to 7 year duration, where we think that volatility will be the least. In terms of corporate bonds, we're looking at some 15% because that is clearly a hedge, particularly kicks in into the second half of the year. What we would do, though, in this capacity is keep away to a large extent from AI-related issuance. That is largely because slightly concerned around the issue of how those investments are being made and the valuation of the businesses that are making them. So just to clarify that a little bit further, what's happened is essentially companies like Meta, Oracle have run out of generating excessive free cash flow and are now using their balance sheet to raise more capital for their AI outlay. Now, in the case of that AI spend, I take you back to an episode we did around AI depreciation. I think that that's overstating the value of the businesses and overstating the earnings capability of those businesses. that obviously would have a telling factor on the value of the bond that those companies are issuing. And I think that is already very tight margins. And I just don't see upside to those corporate bonds. So keep away from AI-related corporate bond issuance. I do agree that the UK inflation-linked bonds, where the generic portfolio had some 2.5%, that we maintain that. So we'll stick to the same level, particularly going into the second half of this year. I think inflation is going to have an impact in the UK. And already prices of those bonds are beginning to reflect that. If you're able to hold cash in yen, that is what I would do, because those are going to be the highest yielding currency. It'll outperform sterling more than likely. I think it'll also outperform the US dollar and potentially the euro as well. So if you're going to hold cash at 2.5%, I would hold that in the form of yen. I would hold no real estate. Presumably that the generic reflection is a UK one, but I wouldn't hold real estate, partly because of that yield steepener that we talked about earlier, which is a bear steepener based on investors' concern that there would be inflation kicking in. If that's the case, it's going to be really tough getting mortgages. But at the same time, I think if it is about the UK, then office is troubled. Residential will probably see continued volume increase, but probably not pricing. Certainly the second-hand market is going to continue to fall, and mortgages are going to be consistently expensive because, again, I believe that UK long rates will stay relatively high, and mortgages tend to be priced off the long end as opposed to the base rate. Less so in the UK than the US, but still this similar. In terms of the alternatives, we look at it slightly differently. So we're looking at an 8% allocation. That is really around listed private equity. I think that gives a very good, if you like, diversification away from the liquid market. It gives duration risk. And duration risk at this juncture, I think, is relatively well priced. If you are finding the likes of the listed private equity firms are trading on relatively good yields at this juncture, I would give an allocation of 4% to gold, if not higher. Certainly as we go into the latter part of the year, we'll probably try and increase that. I suspect that gold is going to continue to perform relatively well in this environment. And copper, starting at 1%, but certainly would be looking at an exposure possibly through through companies, miners, but certainly an exposure to copper is something that would be quite keen to think about as well. So I think the key factors that are worth really talking about here are those issues of country bias. Don't fall for that. The UK, if you are in the UK, is not 42% of where you should be invested, not just because of the weak economy, but just doesn't make sense when you look at it on a global GDP basis. I think that bonds ultimately offer protection, and certainly going into the second half, but keep in mind the returns on bonds have a glass ceiling to them. You can only get back the coupon plus the principal from that investment. There is no unlimited upside that you'd normally get through equity. So if you have liquidity, if you don't have to access capital and you don't have to generate an income stream, equity bias is certainly something that I would be keen to push with. And at this stage, it would be great to break down what we mean by international investing. For the generic portfolio, where international equities account for 45%, they have a breakdown of 66% towards the US, Japan 5%, China 3.2%, Canada 3%, France 2.4%, and other being 20%. The way we break it down is that the overall allocation is just a little bit more than the generic at 70%, but a significant part of that 70% is going to the US, because we believe that the growth in the US is going to be exceptional in the first half, thanks to both fiscal and monetary largesse. Japan, by dint of having a strong currency and repatriation by Japanese investors back into Japanese assets, will be good for Japanese equities. So we put that at 7%. Then we have idiosyncratic investments in places like Holland at 2%, France at 5%, Denmark at 3%, Germany at 3%, South Korea at 1%. Those are really driven by bottom-up investing, really based around specific investments in areas where we think there's potential upside. For instance, France at 5% is a function of exposure to luxury, particularly if we are seeing wealthy investors making more money in the first half of this year. That should drive luxury spend significantly. The likes of Denmark is really around Novo Nordisk and the acceleration in obesity drug sales, particularly now that Novo Nordisk is selling oral form of the drug. And the likes of Holland is really around ASML, which is the world's leading semiconductor equipment manufacturer. So that's kind of where we sit in terms of the international exposure, keeping in mind also that part of where the generic portfolio was in other, we're looking specifically at global emerging markets as providing also that level of diversification at some 10% in our portfolios. So to finish with, I think it's really important also to keep in mind that this allocation implies a significant exposure to technology, both because the US exposure is some 30-35% via the S&P 500 index towards Mag 7 and technology, but also the global emerging market exposure is similar to technology as developed markets because of the impact of TSMC and Samsung and Hynix into the mix. So you are getting a significant technology exposure. We're comfortable with that in the first half, but we really need to think about that as we head into the second half of the year. The key element is that we want to bring more gold into the portfolio and we want to bring more commodities into the portfolio. And lastly, a significant exposure as well towards financials. That broad steepening yield curve creates very, very strong net interest margins for the banks. And I think the money center banks in the US are probably the biggest beneficiaries, the likes of JP Morgan, Bank of America, Citigroup. I think it's also worth keeping in mind that the investment banks will probably have a great year, given at least one of the two huge IPOs are probably going to take place, either the $1 trillion SpaceX or a near $1 trillion OpenAI IPO is probably on the cards. That raises almost between them, $300 to $400 billion. That's a lot of fees. I'll leave it there. I hope we've given a really good, over the last 3 weeks, impression of our strategic asset allocation based on our micro themes, based on our macro assumptions going into this year. The one thing I would say is it is a year of two halves. Let's really have a very, very strong tactical rearrangement as we start to see inflation kicking in, resulting in coming from that excessive GDP growth that I suspect we'll see in the US in the first half. Thank you and see you next week.